Welcome back to the channel, Financial Navigators. Today, we're diving deep into the fascinating world of hard-to-borrow stocks and the potential for a short squeeze. We're looking at a very specific name that's landed on our radar, CIIT International Inc., trading under the ticker CIIT. This isn't just a generic overview, we're going to break down exactly what makes CIIT interesting in this context. Important disclaimer, this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. CIIT logo/info card. CIIT International Inc., or CIIT, operates in the industrial sector, specifically within integrated freight and logistics. Through its subsidiary Rushing International Company Limited, CIIT provides crucial logistics services across Hong Kong, Vietnam, Japan, Zimbabwe, and South Korea, primarily focusing on ocean freight forwarding and container shipping. With a market cap of just $3.02 million, CIIT is firmly in microcap territory. Let's look at the recent price action. Today, CIIT is down -4.19%. Over the last 5 days, it's dipped -5.27%. However, zooming out, the stock has seen a massive plus 676.23% surge over the last 30 days. Joe chart 30-day price action volume-wise today saw only 7,286 shares trade hands, a stark contrast to its 30-day average volume of 212,029 shares, meaning today's relative volume is practically 0x average. What is cost to borrow and why it matters? So, what does it mean when we talk about a stock being hard to borrow, and why is the cost to borrow so important? When you short a stock, you're essentially borrowing shares from a broker, selling them, and hoping to buy them back later at a lower price to profit. But borrowing those shares isn't free. You pay a fee known as the cost to borrow, or CTB. This fee is typically expressed as an annualized percentage. A high CTB signals two key things: either there is very high demand from short sellers to borrow the stock, or, more often, there's a severely limited supply of shares available to be borrowed. When the CTB starts to climb into the hundreds or even thousands of percentages, it tells you that the market to borrow those shares is extremely tight. Why the stock is hard to borrow right now? Show CIIT CTB data. Now let's talk about CIIT. This stock appeared on our hard to borrow screener because its cost to borrow fee is an astronomical 944.4% annualized. That's not a typo, 944.4%. While we don't have data on CTB momentum or the exact number of shares currently available to borrow, that annualized rate strongly implies a scarcity of shares. CIIT has an estimated float of 7.3 million shares, which is relatively small for a public company. Our internal composite squeeze score, which factors in things like CTB, float size, and momentum, currently gives CIIT a score of 49.4 out of 100. This is a mid-range score, indicating significant interest but not necessarily an imminent explosion. It's crucial to remember that a sky-high cost to borrow, like CIIT's, doesn't automatically guarantee a squeeze. It can also indicate that short sellers have incredibly strong conviction in their bearish thesis and are willing to pay a premium to maintain their short positions. Squeeze mechanics explained. So, how does a short squeeze actually happen? Imagine a short seller borrows shares of CIIT, sells them, and the stock starts to rise instead of fall. Now, not only are they losing money on their position, but the cost to borrow those shares is also eating into their capital at an alarming 944.4% annualized rate. If the price keeps climbing, or if the supply of available shares to borrow dries up completely, these short sellers can be forced to cover their positions. Covering means they have to buy back the shares they originally sold, regardless of the price, to return them to the lender. This forced buying creates a surge in demand, which pushes the stock price even higher, trapping more short sellers, and creating a feedback loop that's a short squeeze in action. Dilution risk check. Before getting too excited about squeeze potential, we always run a dilution risk check. Dilution occurs when a company issues new shares, increasing the total number of shares outstanding. This can significantly offset or even negate a short squeeze thesis, as it adds supply to the market, making it easier for short sellers to cover and often driving the share price down. For CIIT, we found no recent dilutive SEC filings such as SMINS1s, SMINS3s, or 424Bs in the last 90 days. This is a positive sign for any short squeeze scenario, as new share issuance isn't adding selling pressure to the market. Recent reverse split watch. There's another critical factor for CIIT, a recent reverse stock split. CIIT executed a 1-for-10 reverse split on July 20, 2026, which was just 35 days ago. A reverse split reduces the number of shares outstanding and, in theory, proportionately increases the share price. So, for every 10 old shares, you now have one new share worth 10 times the price. This immediately reduces the float, which is already a factor in CIIT's hard-to-borrow status. Historically, many micro-cap stocks tend to see renewed volatility or even a price pop within about a month after a reverse split, as the market digests the new share structure and resets expectations. While this is a pattern we've observed in some micro-cap names, especially those with increased scarcity like CIIT now has, it is absolutely not a guarantee of future performance or a squeeze. Important disclaimer: this video is for educational and informational purposes only. Nothing in this video constitutes financial, investment, or trading advice. Always do your own research and consult a licensed financial advisor before making any investment decisions. Past performance does not guarantee future results. For CIIT, given its unique setup, here's what to keep an eye on. First, watch the bar desk for any updates on available shares. A shrinking supply would be a key indicator. Second, sustained high volume, far exceeding its current average, would be necessary for any significant upward price movement. Remember, today's volume was incredibly low. Third, pay attention to price momentum. While the last 30 days have been incredibly positive, the last 5 days and today have been negative. A reversal into consistent upward price action, especially on increasing volume, could signal a change in sentiment or short covering. Finally, keep an eye on any news or developments for CIIT International Inc. itself, or within the broader industrial/integrated freight and logistics sector. CIIT International Inc. presents an intriguing case study with its astonishing 944.4% cost to borrow in its recent reverse stock split. It's a prime example of a stock showing signs of being incredibly hard to borrow, even if it doesn't guarantee a short squeeze. Understanding these dynamics is crucial for any informed market participant. Remember, this information is for educational purposes only. If you found this deep dive into CIIT valuable, please hit that like button, subscribe for more unique stock breakdowns, and let us know in the comments what other hard-to-borrow stocks you'd like us to analyze next. Thanks for watching, and we'll see you in the next video.